My journey into the carbon space has been very non-traditional. I've invented electronic security technologies, bought and sold companies on 3 or 4 continents, developed prisons for sovereign countries, and done structured finance. And then about 4 years ago, I pivoted into what's really been the most interesting intellectual challenge of my career, which was how to create a truly global and institutionalized market in carbon and carbon-linked instruments. And the potential for this is obvious to everyone in the room. Staying on a 1.5 to 2 degree glide slope to net zero requires more than $1 trillion of new carbon issuance on an annual basis, each and every year between now and 2050. And yet, in 2020, outside of compliance markets, we achieved around $1 billion of issuance, growing to about $3 billion of issuance in 2023, which is great. But behind those headline numbers, 150% annualized growth is nothing to sniff at. We should be very proud of that. But behind that is a sobering fact that as of 2023, we're precisely 99.7% short of the annual flow that we need in order to stay on that glide slope. And so some out-of-the-box thinking is always useful to help challenge existing paradigms and introduce new ideas into the landscape. And so we began Laconic in 2021 with the mission of creating a truly global capital markets infrastructure, not creating the market itself, but to bring carbon into the existing landscape of capital markets with the goal of piggybacking on all of the work that has gone before. We stand on the shoulders of giants, right? And so if we could find a way to tap into the existing apparatus of financial flows with carbon in a way to make carbon not special, but to make carbon just another financial product, then we could potentially unleash the power of the existing capital markets. And I'll give you an idea, framing in a capital markets context, those amounts of flows, that $3 billion of VCM flow in 2023 is about 30 minutes of deal flow for a mid-sized US Treasury desk on a Monday morning. And so that's kind of the difference in scale that we're dealing with, but it's also the opportunity that if we can find that way to package. So as outsiders looking in, we built a team of financial industry professionals who've got over 250 years of experience in the C-suite at Laconic, in structured finance, in information data systems, financial analytics, and the like. And we perceived the problem through a different lens. We didn't perceive a supply-demand mismatch. There's plenty of demand and there's plenty of supply, if supply is defined as tons of CO2e, to make a market. Nor was there an integrity crisis. And by that I don't mean to denigrate what the ICBCM and all the work that's been going on in integrity is. That has actually provided a foundation for driving confidence and trust into the market. But there was enough integrity before that we actually could make a market. There are plenty of financial products that are traded with substantially less data integrity than a typical VCC has today in large markets. So integrity is critically important, but it's not necessarily a condition precedent to capital markets activity in carbon. And so what we perceived was that what hampers the VCM in particular is really a structural impediment, that it's baked into the heart of the enterprise itself, that the market really isn't a capital market, it's an ad hoc series of unregulated buy-sell transactions between two sets of counterparties. And interestingly, those counterparties are really singularly ill-equipped to undertake the transaction portion of the value chain. And I'll give you an example of that. On one side, we have project proponents or reduction or removal activities. And these are specialty enterprises that are dedicated to undertaking these activities. But in addition to their core business, the VCM market paradigm asks them to also do something else for which they're relatively ill-equipped, to directly market their product to a heterogeneous, wrong word, the other way around, a heterogeneous market that's dispersed all over the world, and to ask small and medium project proponents to build a global sales network to sell their wares. This is very, very difficult for them to do. And on the flip side, on the buy side, on the corporate end user side, we ask them to dedicate resources outside of their core business to finding these project proponents and tracking them down and doing project level diligence. And so this is a situation that really cries out for financial intermediation, because the inefficiencies that are intrinsic to this paradigm are transaction friction costs equal to more than 400% of the underlying value of the thing being traded. So imagine buying a share of Google, transaction closes, and then you get a bill from your broker for 4 times the price you just paid for that share of Google. You wouldn't have a market. There would be no equity market if the transaction costs were that high. But those are the transaction friction costs, full cycle transaction costs, endemic to the voluntary carbon markets, which is why there's no large-scale capital markets activity in the VCM today. The intellectual costs of facilitating that financial intermediation are very high, however, because it requires a paradigm shift in our collective thinking. It requires us to recognize that each quantum of carbon or each quantum of data that represents the carbon claim, whether that's avoidance or reduction or removal, whatever regulatory or methodological framework at a base level, a ton of CO2e, that quantum of data, that structured data, is not in and of itself a negotiable financial instrument. So we have to take this information, which constitutes a VCC, the core of the claim that a methodology has been properly implemented, that it's high integrity, and all of the characteristics and that infrastructure that the marketplace has built in order to ensure quality output of the carbon factory. Because you can think of an additionality activity as a factory, and the output of that factory being carbon units, tons of CO2e. But unless that information is structured as a negotiable financial instrument, it cannot be traded by regulated capital markets providers. It can't be traded at scale by banks, by hedge funds, by insurers, by sovereign wealth funds and the like. And my team and I have been all over the world, and bank after bank after bank has told us, when we can trade 500 million a year on our single desk, and when compliance will rate it, and when legal can tell us that this is a valid instrument that's recognized under the securities laws of our country, we'll enter the market. We have demand, but we can't make any money, and the regulator won't allow us to transact in the instrument as it's currently structured. Right? And so we need to close that gap. And I'll give you a corporate finance example of this. If you're a CFO of a corporate end buyer and you're purchasing VCCs to offset your enterprise's emissions, how do you book that transaction? You book it this way. You take cash off your balance sheet equal to the purchase price of the VCC. It flows through your P&L as an expense. Okay, that's kind of usual and customary. But what do you get in return? When you take delivery of the VCC, you're required by FASB to post a matching liability on your balance sheet equal to the purchase price. So you just paid twice. If you pay $10 for your credit, from a corporate finance point of view, it costs you $20. This is part of these transaction friction costs I was talking about before. Why do you have to book that liability? You have to book that liability because you, as the holder of the VCC, are making a claim that the environmental benefit embedded in the VCC, the right to offset your emissions, is in fact legitimate. And because there's no binding legal promise by the issuer of the VCC as to the legitimacy of the VCC, everybody declaims it. The registries declaim it. The project proponents declaim it. It's almost the inadvertent revenge of the lawyers because everybody along the value chain has declaimed responsibility. But that means that the buyer, the end buyer, owns the liability. There may not be integrity, that this may not represent a valid claim. And so they have to book it as a liability. And so because of this, you have this originate to retire modality that has taken over the marketplace. No one wants to hold a VCC on balance sheet because it's financially untenable to do so. So you can't have a capital market in an instrument that doesn't have any intrinsic financial value. So the challenge here is to create intrinsic financial value that goes along with the intrinsic environmental value of the carbon instrument. Nobody in this room or anywhere would argue that there's no intrinsic environmental value embedded in the carbon credit. Of course there is. But we also need to match that with intrinsic financial value. And that will create a securitized market in carbon. And that's really what is required to build this securitized market. A market where carbon-linked instruments are legal securities that are issued by regulated financial institutions. It's a binding promise on the part of the issuer as to the legitimacy of the claim or the activity. And it's issued pursuant to a prospectus and securities laws and the like. Because then, in that market, you have the same activity, it's just packaged differently. But the benefit of that packaging is that buyers and sellers can transact in a product that represents a binding obligation that has a financial value, a dollar value attached to it. And because of that, when you transact in this instrument, you book it as an asset. You take cash off your balance sheet and you replace it with an asset of equal value. And then you mark that asset to market. And now you begin to have a financial intermediation possibility, because that securitized market allows you to hold that asset on your balance sheet. It allows for institutional participation because the global capital markets know what to do with securities. It allows for standard form settlement. It allows for central clearing. It allows for established custody of the assets. And all of these functions are battle hardened, right? The systems in the capital markets transact trillions of dollars across various asset classes every single day. And that simplifies the task of us here in this room, because we inherit the distribution channel of the global capital markets. Now, we don't have to ask a project proponent to go find a corporation on a continent around the world to sell 10,000 credits or 100,000 credits for it or like. We can create a distribution channel that leverages the power of the global capital markets. That securitized market also allows for the creation of complex instruments, derivatives, forwards, future contracts, options. You can short carbon. It's not possible to do today. And some may say, well, that's just financial speculation. To which I would say, exactly, it is. It's not a bad thing. It's a good thing. The speculation in price movement drives volatility into the marketplace. That volatility creates liquidity, and that liquidity creates price discovery. All of those things are completely lacking in the current voluntary carbon markets. Nobody knows when they undertake an additionality activity as a program proponent what the value of their product will be when it comes available. It's impossible to model forward. Some of the large exchanges have tried CME, ICE, some contracts based on some AFLU, VCM. The CME contract, I have a close relationship with them because their headquarters is across the street from ours in Chicago, has 700 contracts outstanding today. So basically nothing. And they're also facing $150 million litigation for lack of data provenance underpinning, because they are unable to rep and warrants as to the accuracy of the underlying positions in the basket. So this is just another example of kind of these structural impediments. So in short, if we take all those things together, we have a chance to create that $1 trillion of issuance a year. And that $1 trillion of new issuance grows 4 or 6 times with secondary market transactions. That's people buying and selling the carbon instrument, not as a financial asset, not with an aim of directly offsetting their emissions, which at any time any holder could do, but it's voluntary. So you can choose to treat it as a financial asset and trade on price movement. That adds 4 to 6 times notional flow volume in the marketplace. So now that $1 trillion of carbon issuance turns into $4 to $6 trillion of capital markets activity in a global context. That is a new asset class. In fact, the first new financial asset class in the capital markets since credit default swaps were invented in 1997 by Gilmour. So how do we take a packet of data that embodies a claim as to the avoidance, reduction, or removal of CO2e? How do we turn it into a security? Well, we do that with technology via an innovative platform called a data interchange fabric that combines the information provided by activity proponents, MRV providers, registries, and the like, the existing data ecosystem of the VCM, with additional layers, because the VCM data ecosystem does not track a sufficient quantity or type of information to create a negotiable financial instrument off of it. So we have to add additional data layers to what exists. Jurisdictional provenance, right? Does the project proponent own the land? Do they have the legal right in the jurisdiction where they're acting? Data lineage, digital chain of custody, and on-demand validation of permanency, right? To shrink the validation window from MRV every 5 years, right? In the case of RED Plus and JRED projects, for example, to the ability to validate the continued permanence on demand through remote sensing and the like. And we currently have the ability to do that on a 72-hour roll if you want to. You take all of that data together and you structure it in a way to create a harmonized reference data product. It's called the security master. And for any of you that have any fixed income experience or like, this is the data packet that underpins all publicly traded financial instruments, right? Stocks, bonds, and the like. and it's what allows them to be analyzed, priced, traded, and valued. But that security master itself is not enough to support the capital markets activity. We need to layer on 3 additional layers of data. Each is critical to the creation of a full stack origination pipeline for carbon. In the first layer, we call Laconic the area of interest, the precise location of the activity giving rise to the carbon credit or the claim. Carbon is a characteristic of the land. While it's often traded as a commodity, it's really not a commodity. It doesn't fit the legal definition of a commodity for a variety of really technical reasons and one really big non-technical reason, which is the one I'll highlight here. Carbon is a characteristic of the land. Physical delivery is an impossibility with carbon, right? If you've reduced or removed, there is information about the land, and the permanency requirement requires that the carbon stay in the land. So when we talk about trading carbon, we're not really trading the carbon. We're trading information about the carbon. Now, this is much more akin to a swap than it is to a commodity. But because we're trading information about that carbon, we have to know where that activity occurred. Carbon is a characteristic of the land. Fewer than 40% of registered projects in VCM registries had any form of geospatial information submitted to the registries that outlines the extent, the boundary of the area where that activity is taking place. Well, if you don't know where the activity takes place, of course you have double counting. You can't deduplicate the data store. And if you want to have a global market, not a balkanized market that's limited to registry-specific or country-specific silos, you have to be able to deduplicate the global data store, and that starts with knowing where every activity comes from. And so it is possible to do this, and through remote sensing and digital technology. So we have to build that up. That's the first layer. The second layer, now that we have that location information, and by the way, I should say one more thing, that's location about each ton of CO2e, not a project proponent or an activity, because ultimately what is being traded is the product of those factories, not the equity in those factories. And so it's the CO2e itself. We validate that AOI. Now we need a unique identifier. If you can't name a thing, you can't trade a thing. And that identifier has to be globally unique. It can't be just a registry identifier. It can't be just a country identifier. It has to cross registries. It has to cross methodologies. We have to create a universal data taxonomy so that we can talk about every ton of CO2e in a common base language. And we can layer on as many layers of regulatory information as we want onto that base layer, because there are different regulatory requirements for different sections or subsections of the market. But at that base layer, we can now name it. And it is another thought exercise I'll ask you to think back to the equities markets or the fixed income markets. Imagine trading stocks or bonds without an ISIN or a CUSIP. The market wouldn't work at all. There wouldn't be a market. Well, there is no universal identifier. There was no universal identifier for carbon. When you have this identifier, now you can create a global data store of carbon, individual tons of CO2e that you can combine synthetically to create baskets, to adjust your risk, and go across methodologies. One more thing about that identifier, the thing that does make carbon unique and very different from a stock or a bond is that when a stock or a bond is created, its permanence is known, right? Because it's created through a legal process. Company creates a share of stock, it exists until it's repurchased and retired. Carbon is different. It's a characteristic of the land, right? So there's nature-based jump risk inherent to carbon. If you have forestry carbon, for example, the forest could burn. The forest could be timbered, even though it's supposedly protected. And so there are ways that the claim of permanency can be voided. And so that identifying data structure has to track, it has to map a dynamic natural system, the Earth, into a capital markets construct. So it's not as simple as just slapping a label on a ton of CO2e. You have to be able to enumerate that entire life cycle. When you can enumerate that life cycle, the last layer you need is that you have to introduce a quality layer. And I talked about how carbon is data and is information as a base unit. And here we can compare this to the oil market. Oil is priced in barrels, but it has different qualities, right? There's a different quote for Brent, for Arabian Lights, for different grades and the like. It's the same thing with carbon. No matter how high integrity the production process of the carbon is, or the carbon unit is, at the end of the day, it remains data. And there's good data and there's bad data, right? More complete data. So we have to introduce the quality layer, like credit ratings for bond issuances or the like. So what's AAA carbon? AAA carbon, the carbon unit itself, is complete transparency of source data, complete transparency of methodological computations, derived statistics on the MRV model so that we can measure the applicability and the accuracy of the model. A digital chain of custody with no humans in a loop. You want to make a compliance officer's head explode, right? Tell them that, how'd you get the data in? Well, somebody keyed it in manually, right? They hate that. And so you can score carbon because there are MRV providers that are better than other providers, just like there are in any market. And so by bringing in the quality layer, you create a price curve. And this market so desperately needs a price curve, right? Because right now, because of the opaqueness of the instrument, everything trades to the lowest common denominator because it's impossible to verify the differences between the information quantity of the units. And so actually the price discovery mechanism is working properly, right? Carbon is low priced today because it's not validatable. And that applies to any credit. It applies to a CCP credit or the like, because at the end of the day, you still have to be able to validate them. If you combine all those ingredients together, you have a full stack carbon origination platform that creates negotiable financial instruments from VCC data. So all the activity that has been happening in the marketplace for project proponents, methodological improvements, integrity initiatives and the like stays the same. But the missing piece of the monetization chain is now filled in, because now the output of those processes is converted into a negotiable instrument that has value. It has intrinsic value in and of itself, and it can be traded by the existing apparatus of the capital markets. And I don't want to turn this into an advertisement for what we've done, and I know I need to wrap up, but this is what we've created at Laconic. We've created that origination platform that takes the output of activity and turns it into instruments that can be traded by the capital markets, opening the door up to letting us get to that $1 trillion of issuance a year and keeping us on that glide slope to net zero. So thank you for listening this morning, and hopefully you all can join us on this journey. Thank you.